On today's video, we're going to be doing something a little bit different. Usually we look at not high yielders, but companies that pay in between 3 and 5% in that range. Today we're going to do something a little bit different. We're going to look at low yield but high growth companies. On my list here, which is very concentrated, I have 4 companies, 2 of which I own currently. The 2 that I own currently are CCL.B and CP. Now, I've owned Nutrien in the past, and one I'm a little excited about right now that just had earnings that were pretty good, but the market found them not so favorable, is Waste Connections. I'm just going to highlight Waste Connections here for a second, and as you can see, if you look at the 5-year chart, this thing is going up and to the right, and so are a lot of the metrics when you look at the financials. We're going to do a little quick dive today, not a deep dive, so I'm just going to touch on the yield here. It's 0.89%, so this is minuscule. However, they did just announce a raise. They just increased it double digits to 11, I believe it was 11.8%. They just increased it, which is very, very good. But I mean, this thing trades at a humongous PE here. It kind of reminds me of Costco at 39. Now, you could take this a couple different ways that it's overvalued, but the way I like to look at it is that it is just very, very high quality and people want to own it and not sell it. One of the companies that I owned, I mentioned, is Canadian Pacific, and if we take a look here year to date, it's down a little bit. I think my average is in the 103 range. It's currently trading at $96 now. I wouldn't say that this company is a steal right now. It's hard to determine because they just had their quarterly results. They weren't good. Okay, they were not good, but they were kind of expected to be nothing to get excited about. The same thing with CNR. They were not good either. I would say they're borderline bad, but they're both expected to not hit a home run right now. That you're just looking for a base hit. If we take a look here, the dividend yield is currently 0.79%, which is surprisingly even less exciting than Waste Connections. Now, the one thing I will say about KP here is that it has obviously just done a humongous acquisition and they haven't increased their dividend. They're not going to either. For all you dividend investors out there, they need to lower the debt because they took on a humongous amount. They need to buy back shares because they diluted the shareholders a lot. Now, none of these things are bad. I think it's going to be accretive to shareholders long term because obviously they bought Kansas City. So it's just part of the game plan right now. I don't know when they're going to start increasing the dividend. I don't know how long it's going to be for them to get everything under control to maximize the synergies from the new company. Those are a bit unknown right now. To my knowledge, management hasn't hinted about the dividend for now. But when they do start increasing, I would imagine that it'll go back to double digits like it was in the past. Now, CCL.B, the other one that I told you guys that I own, it's paying a slightly higher yield. Yet again, nothing to get really excited about here. We're sub 2%, so 1.97. Currently, it is a double-digit dividend increaser. Now, I did actually hear about this company from the dividend guy, Mike there, if you guys have heard of him. He's pretty good. He's pretty knowledgeable on these dividend-growing companies. I like what he has to say. Now, I didn't buy it because he bought it. He was talking about it on a podcast, and I was listening, and I thought to myself, okay, let me check this company out. And when I did look at the financials, I thought, wow, it's actually pretty incredible. Then I took a look at the 5-year chart, and you can see it really hasn't done much of anything. However, the numbers keep getting better and better every year, so I believe in this company going forward. The numbers are fantastic. We are going on an economic slowdown right now. This is a bit of a sensitive industry to that, but I'm going to just keep adding a little bit at a time to my position here. I think in the long run, a company with ever-improving financials is one that I want to hold. And lastly, we have Nutrien. Now, I mean, this one is kind of a higher dividend yield. It is on my low yielding list, but last time I looked at it, it wasn't this high. So as you can see here, the stock has come down a lot this year, 21%, but this is a volatile stock. This, doesn't matter what management wants to do. They are at the women mercy. This is a commodity. So currently the yield is 3.7. They are dividend raisers. The payout ratio is low enough for the company to keep raising the dividend even with slightly lower commodity prices. I will be purchasing this stock if it gets pretty much any lower. I've owned it in the past. I treated it like a bit of a trade because of the commodity nature of it. But I think this is a pretty good entry point right now. So I'll take a swing once I have some money freed up. So there it is, guys. That's my low yield, high growth list. I only own 2 of the 4 currently. I'll let you guys know if I pick up the other 2. But let me know if you guys have some low yield or high growth companies that I may have missed. I would like to add them to my list and start adding more companies to my portfolio. All right, guys. See you in the next video. Thanks for watching. Like, subscribe, all that good stuff. Bye.